On today's episode, we wanted to jump in because there's a lot going on in the world right now. Headlines are running rampant, markets have been really volatile, and when that happens, emotions tend to run pretty high. So now here's the thing though, like we've seen this before, different headline, different part of the world, but it's the same feeling. And a lot of that all just boils down to uncertainty. So today, David and I, we're going to unpack on what we're seeing and really break down how that translates to investing. So, David, want to kick it off here. Let's start simple. Let's set the stage. What is actually happening in the world right now?
Let's make a disclaimer here that we are recording at 2:38 p.m. on Monday, March 23rd, 2026, because things are happening rapidly, and it is important to realize that what we talk about right now in this moment might be different and when somebody listens to us in a week. And I ran into this over the weekend when I had written up a communication on Sunday night, assuming that things were status quo in relation to the level of hostilities that were happening in the Middle East at that time. And this morning, there was a report that President Trump had tweeted something out. I guess Truth Socialed something out right now that said that we were stopping the attacks for the meantime to bring Iran to the table, and the markets, the markets reacted positively to that news. And so, very fast moving, hard to keep up with it. So, where we stand right now is hopefully a resolution to this. I think everybody is hoping for that, not just from a stock market perspective. There are lives being lost on both sides, and it would be in everybody's best interest, I think, to come to an easy resolution to this, or at least a swift resolution to this.
Yeah, for sure. I think what a lot of people are talking about, and I'll say Alyssa specifically asked me, my wife last week, she's just like, Pat, what's going on with the price at the pump? So beyond just the price at the pump, which everyone is experiencing, like how does oil kind of play a role in what you're kind of looking at behind the scenes from an investment standpoint?
Oil is the most important commodity that is a part of our lives because it impacts everything in our daily life, not only transportation, but also manufacturing. It increases input costs for production, for manufacturing, transportation costs for delivering those goods and services. And so it has the potential to be an incredible disruptor to the way that things have been going in the near term, because it just changes the game. As oil prices go up, typically that is a precursor to market stress, market volatility. Oil is also, as you mentioned, the gasoline prices. It is the most front and center measure of inflation that people have outside of maybe grocery store prices. But I would even argue it's more prevalent than that because you see the price of gas every few miles on your way to work in the morning. And so it is definitely at the top of everybody's mind. But as I mentioned, oil is going to have so much more of an impact than just gasoline prices. It is pervasive across our economy.
Yeah, for sure. The other thing that's really being talked about a lot is interest rates. And interest rates can be, I think, a pretty tough thing to grasp, especially in the field of finance. So can you break it down into like why are people concerned about interest rates and how it's that affecting kind of some of the charts and graphs that you're really looking at?
So on the level of concern, obviously people are concerned with increasing interest rates. We don't necessarily want to see interest rates go up. It makes everything more expensive if you're borrowing money. But there's a knock-on effect from oil prices increasing and translating to higher interest rates. So let me break down the math behind the scenes. And that is that as inflation increases, and oil is a key component to that, not only because it's a line item in most in inflation calculations, but also, as I mentioned before, it's also going to make other things more expensive as well. So as inflation goes up, interest rates tend to follow that up. And the reason is because interest rates are based off of the price of bonds. And if you are holding a bond that is promising to pay you back a certain amount in coupon payments and then the principal at the maturity of the bond, if the value of those future payments is being devalued by higher inflation, the interest rate that you are going to have to entice a potential investor with by selling that bond, if you're a corporation or if you are holding one and you're selling it on the secondary market, you're going to have to offer a higher interest rate to compensate that buyer for the devaluation of those future cash flows. And so as bond prices come down, interest rates go up, and it then also has effects on other things in the economy. We've seen mortgage rates go back up in the last few weeks as interest rates across the board have gone back up. Credit card rates can also go up. I think a few of our listeners are probably remember what the interest rate environment was like at the end of the 1970s, early 1980s. It was not atypical to have a 15 to 18% 30-year mortgage at that time. And that sounds ridiculous to people in today's economy, but that was the outcome from the 70s. The 70s were a highly inflationary period, and interest rates adjusted accordingly.
So, like, really, what I'm hearing, a lot of these things are connected. So, like, we started off with the oil, prices going up, which could translate into interest rates potentially going up. So, like, you are really looking at this from a grand scale. You're not just focusing in on like one asset class here. Like, you're looking at this from a broader perspective. Did I get that right?
The title for that is intermarket analysis. We want to see not only how certain markets are behaving, but then
Hmm.
also what the interrelatedness is of that market to other markets. Everything is connected in some way, shape, or form. And when financial markets are moving along and things are humming smoothly, as we saw, in the last couple of years, as the stock market went up, bond yields were, when I say yields, I mean interest rates, when they were somewhat stable, not moving too much in either direction. I mentioned at our Monday morning meeting internally today about the market despises when interest rates move too fast in either direction. If it goes up too fast, it usually means that inflation is on the horizon. If it goes down too fast, it usually means that there's some sort of recession being priced into the bond market. So that is a situation where you have to monitor what is going on in interest rates and decide accordingly what you're going to do with your portfolio.
Perfect. Let's see if this is connected. Let's move to gold and silver, because I think everybody started to talk about it last year. Everybody wanted in on the gold trade. I know that was a portion of our client portfolios, but like, talk to me about what's happening with gold, because I know that it's been coming under a little bit of pressure even this last month.
It's funny because you would assume in an inflationary environment that gold
People
would
need
be a
gold.
beneficiary of a higher inflation. It's not that easy. And what I mean by that is in the short term, you're going to see dislocations based on certain elements that you may or may not have taken into account before doing your analysis. And interest rates are going to be a component of the gold price. And it, again, doesn't really necessarily make sense on the surface, but once you break it down, gold is a non-interest bearing investment. You're never going to get a dividend. You're never going to get a coupon payment from your holding in gold. It is a zero yielding investment. So if interest rates move too high, too fast, that means that the opportunity cost for holding something like gold is going to be that much more stark. So it makes sense to be in a higher interest bearing investment versus a zero interest bearing investment
I don't know.
in that short term. So as interest rates move up, typically you'll see a negative price reaction in gold in the short term. The other thing that gold has working against it in the current moment is that in the beginning of this year, gold's price increase was unsustainable. At one point in January, it was up over 25% year to date. And that was after a great 2025 and a great 2024. So anytime you have this bubble type of environment when it seems too easy to make money, usually you need that price to move down and sometimes swiftly to get rid of the excess optimism in the asset class before you can make any sort of meaningful advances. So that's um, probably the two biggest reasons. There was also some
Okay.
rumors that uh, because of the situation in Iran, global central banks, which had been stockpiling gold over the last few years, they were forced to sell some of their gold to actually use maybe the whatever cash they were preferring in that moment to pay for whatever their operations were, or to hold some liquid foreign currency. I don't know the full reasoning, but that was the rumor, is that there has to be an institutional size seller of gold and silver in the moment because of the geopolitical conflict right now.
So there's a lot going on
There's a
with
lot
gold.
going on at all times.
Yeah. All right. Let's go. One more thing that I think tends to be on people's minds. And like we talked a little bit about oil, but like commodities from like a broader scale point of view. Like what's happening there? There's definitely been some volatility. It's done pretty well this year. What's your kind of take on just the overall broader commodity space?
So we already touched on two major components of commodities, and a broad commodity index is going to be comprised of your oil and other sort of energy commodities. You're going to have precious metals, and then you're also going to have some agricultures. If
Mm.
you've ever watched the movie Trading Places, the orange juice futures, like those are all built into the commodity complex. And so commodities in general are an inflationary hedge to a portfolio. So typically
Mm.
you would include commodities as a hedge against future price increases, because you're essentially owning the things that are increasing in prices from commodity driven pressures.
Okay. Okay. All right. That makes total sense. So, okay, we've covered a lot of what's happening in the world today and how that kind of translates to the investment landscape. There's a lot of headline noise, and you mentioned it in the beginning. So I kind of want to get a glimpse into David's world. Like, how do you approach that, managing the portfolios in terms of like, are you listening to the headlines? Are you tuning them out? And like, where are you going to get your information?
I go to the charts on my screen to get my information. I think it would surprise most people that I don't watch the news. I don't listen to the news. I don't read it. I'm obviously aware of developments in the world. I have to be, but the major
Yeah.
news finds me, right? I'm not going out there searching and reading newspapers front and cover to cover, because I get much more valuable information by how institutions and the people who move markets by positioning their investments, how they are positioned for the environment. So I get much more information by seeing how an stock market index trades, or what's happening in interest rates. I get much more information in that form than I would by reading a journalist's opinion or reporting on a certain news story. But of course, the news will trickle down. I find it, it finds
Yeah.
me in my job, but I don't go out there searching for it. I find it much easier to be objective in my job by cutting out that noise and then focusing on what matters.
Yeah. Let's go a layer deeper. So it's like, you're trying to tune out some of the headlines because a lot of it is fueled based on emotion, right? And invoking emotion, let's say. You're utilizing the charts to be more objective. How does that then translate to the way that like you're approaching portfolio management from a greater scale? Like I'm guessing it's going to be more objective, you have more of a process. But tell us more about that.
Yeah, and the beauty of watching financial markets as a way to get what's happening in the world is that is the truest form of data we could ever get, is
Mm.
the price at which something traded for in the past. So, and whatever that trend is, and I can probably do a separate podcast on how I think about looking at the markets. But when it comes to managing portfolios, we have a predefined process in place for managing that risk. And what I mean by that is anytime you're investing, you are assuming some level of risk or some form of risk or both. And you have to be aware of what that risk is. And if you are the traditional buy and hold investor, the risk that you're assuming is that in times of market stress, let's use 2022 as an example, we saw stocks and bonds go down together in that year. So they ended up coming back, but there's going to be times, look at the 1970s as an example of times when stocks and bonds both do poorly for an extended period of time. And the risk that you're assuming if you're a buy and hold investor is withstanding that potential multi-year, maybe more than a decade storm to come out on the other side. And during that 10-year period, whatever time frame it works out to be, you're going to be questioning your sanity. And this is the Retirement Done Right podcast, and I want to tie it back to a retiree. And retirees, as I like to say, only get one shot at this. And so if your portfolio declines and it stays down for multiple years or decade plus, you are going to be changing the trajectory of your retirement years. You're going to have to cut your spending unless you had a stockpile of cash before all that happened. But if you had a stockpile of cash and we're in an inflationary environment, guess what? You preserved your principal, but you're seeing the purchasing power of that diminished year over year as inflation takes hold. So risk is something that you cannot get rid of. You can only transform the type of risk that you're taking. And so in my seat and managing portfolios, we have a predefined process for what risks we're assuming, how we're thinking about managing that risk. And my ultimate objective is to hopefully preserve capital or preserve people's money during periods of market stress. And then as the market heals itself and starts to move higher, we still want to participate in that long-term growth, but we also want to be cognizant of the risks that are present in markets at all times. That can be something like this, where this was a little bit telegraphed. We knew that we were probably going to have some level of action taken in Iran. We were talking about it for a few weeks. We saw actually oil prices start to go up before anything happened, and then it manifested itself. And now it is a risk that's present in the market. And we want to lean on everything that we have thought about and read about and developed into our portfolio structure up to this point. And then we want to stick to our guns moving forward.
Yeah, for sure. And I think I like how you tied it back to retirees because I think it like markets like this hit different. Like when you're accumulating assets, you're not always as attuned to it, but when you're actually starting to take distributions, that's when it rings a little bit more true, right? Because this is the nest egg that you have that is meant to last a lifetime. And I think on the planning front, like I always mention, like the importance of like being flexible and dynamic. When the market's rip roaring, maybe you could spend a little bit more. The portfolio's doing well. But if the market's drawing down, right, then hey, can you cut back spending a little bit to kind of help your long term? So I think it all goes into play. Just being dynamic and having a process and being prepared for when things like this happen.
I use
Um,
the I use the example of 2008, which was in the midst of the global financial crisis. For anybody that is a prospect or a client, you've seen our portfolio presentation about how we think about managing risk. And I use the example of the Vanguard Balanced Fund, which is 60% stocks, 40% bonds, excuse me, 40% bonds, which most people would what most people would agree is fairly conservative, or maybe moderately conservative. If we want to mince words here. Um, Even a 60-40 portfolio in 2008 still lost over 35% of its value top to bottom. Imagine you were a retiree, put your retirement papers in 2007, and you watch your portfolio go down 35%. Now, it came back and it's much higher today than it was at that low point, but that is a really scary time where you're questioning your sanity and questioning whether you're going to have to go back to work. We would much prefer in our world to hopefully limit the drawdown by taking proactive risk measures and managing risk throughout volatility.
100%. And having a plan that's prepared for that. Yeah. So for everybody out there that's listening and they're not involved with Continuum, they're just listening, like how could you take stock of your portfolio during times like this to see like are you allocated appropriately or maybe, you might need to make some changes. Like how do you go about it?
I would say the easiest thing is to see how your portfolio reacts, not only just individual components, but as a whole.
Yeah.
And 2022 was a perfect example of maybe the need for additional diversification in investment styles. We have buy and hold components as part of our portfolio. That's our core. But if you are holding on and everything is starting to move in the same direction all at once going down, chances are you could probably add some other elements to it that can only improve the outcome, maybe relieve some of the mental anguish that you're going through at a period of time. Nobody likes to lose money in their portfolio. It's going to happen to everybody. You just want to make sure that you're being smart about the risks that you're undertaking. And so if you're watching your portfolio and you're seeing everything start to go down together, chances are you might want to adjust some things or talk to a professional that is trained in risk management and portfolio management.
That makes sense. So basically, it's like take stock of every position that you're in, and then take stock of it as it is coordinated, right? So asset allocation, call it, and then ensure that you have like proper layers of diversification. I love it. Last question for you, David. So for those that are still listening in, like, what's like your one key takeaway that you want someone to take away from our talk today?
So it's a little late for it now, but have a plan before things start to hit the fan. And in the midst of everything as we are right now, and market is up, at least as far as I could check, a couple of minutes ago. It can change on a dime. And so I don't necessarily think that we are out of this episode at all. We still have to wait to see how everything plays out. But in the midst of everything, don't panic and don't change your investing style based on emotions or because things are starting to go down.
Yeah.
We all know that this is part of the process. It's never fun to watch your portfolio decline in value. But if you start to make adjustments based on how you're feeling in the moment, chances are you're going to make a mistake. And then that's going to compound over time because now you might be chasing the prior mistake that you made. If you make another mistake in that area, now that problem is just compounding into a bigger one. So I would say have a plan going in before things start to go south. And then once you're in there, then stick to your guns, stick to your process, and realize that things are probably going to improve at some point in the future. And then it's a good time to readjust and get a sense of what type of risks are you comfortable, how much risk are you comfortable with, and then adjust accordingly when things are a little bit calmer.
Love it. So prepare and don't panic when things start going sideways. And then at the end of the day, like have a process, like, and it's not a process rooted on emotion. You shouldn't just be winging it, dependent upon what the headlines are throwing at your way. You should have a very defined process that's a little bit more objective. You get that right?
Yeah, you want to be as unemotional as possible when it comes to money. And that's really hard to do because money is inherently emotional for everybody. And you want to remove the emotion from the decision-making process. And having a plan going into an episode such as this only helps you to lean on that version of yourself that was unemotional, right? If you are preparing and saying, this is how I'm going to act given a time of stress, and then that time of stress happens, chances are you have a little bit more to lean on. But if you are now reacting to whatever you're seeing in the headlines or watching in your portfolio that's declining, chances are you're going to make a mistake.
Yeah. Get emotional in how you're spending your money in a good way, hopefully, right? Like enjoy the money that you saved for and have fun with it, but be unemotional and be more objective in terms of how you're managing your money.
Yes.
Let's go. Love it. Well, I think we could cut it there. Anything else, David?
No, I'd say come to us with any questions. Happy to talk about the markets with people. And so if you have any follow-up questions, reach out to us. More than happy to dive deeper with people.
That's good. Thank you.
Take care.
Thanks for joining us for another episode of Retirement Done Right. To learn more, visit us at contwealth.com.